I have something to say in terms of about concentration versus diversification. I think it's important at this time because the way the market is moving and the exuberance, what many would call the AI boom, the technological revolution, something to understand and just know for yourself in terms of where you're at financially and how you can build wealth and how it works. Because it's more simple than it's quite simple in terms of the stock market and other assets, but in case you didn't know, concentration builds wealth, diversification preserves it. You need to know which game you're playing. Your financial advisor won't ever tell you this because if they did, they would not be able to charge you a fee to manage your index funds and government bonds and whatever else they convince you was responsible. And most of you don't even have a financial advisor. That's the point. Most people are given preservation advice when they don't even have anything worth preserving yet. That is the problem. Diversification is not a wealth building strategy. It is a wealth preservation strategy. The two are distinct, and conflating them is one of the most expensive mistakes that a young person can make, especially in these times. The entire financial services industry is built on selling you diversification. Spread your money around, never put your eggs in one basket, be risk averse. While these sound like wisdom and they feel like caution, they're actually just a sentence. If you're 25 years old with $40,000 in savings and someone puts you in a diversified portfolio of bonds and international equities and commodities and real estate investment trusts, they have not protected you. They have limited you. They have taken your one real asset, which is time, and neutralized it. Time in the market always beats timing the market. There is no crash coming. There will be no failure that you cannot learn and recover from. The opportunity exists only if you understand it. Inflation is running at roughly 3 to 4% annually. In a normal environment, maybe 2%, ideally. And that's the floor. You can't change that. It won't be at zero. That's not how it works. The system wasn't built for 0% inflation. People don't understand this. People criticize the Federal Reserve and its independence, and they just simply don't understand economics. That is the minimum that your money needs to return in order to stay even 2, 3, 4%. And that's not even if your wages don't keep up and if you're not willing to take calculated risk. Every savings account, every money market fund, every certificate of deposit is fighting that conflict and losing it slowly. If you are beating inflation by 2% per year on a portfolio of $50,000, you're generating $1,000 of real additional purchasing power annually, which is basically nothing, and you will be dead before that compounds into anything meaningful. Diversification at such level is not a safety net. It's poverty with comfort. Excuse me. Or diversification is a risk in itself. Concentration is what builds wealth. That is a fact. That is what history shows. The people who got rich did not do so by spreading their money across 40 asset classes in separate baskets. They found something, they believed in it, and they loaded up. That is how it works. Time is your greatest asset. That is how it has always worked. The mythology around diversification exists because it protects people from catastrophic losses. And that is a legitimate concern, but only if you have something worth protecting. That's the point. If you're 30 and you have $100,000 and you lose 50%, you only have $50,000 left, well, that's recoverable. You're still young. The clock has not run out. But if you're 40 years old and you spent the last 15 years in a diversified moderate risk portfolio earning 6% annually with inflation averaging 3%, you've effectively earned 3% real returns on what was never enough capital to begin with. And now you're sitting on maybe 250 grand, wondering why that math doesn't make sense. That is the actual cost, not a market crash and not a recession fear. The slow grind of playing the wrong game forces your hand. Just think about what you had missed. Between 2013 and 2023, the S&P returned over 200%. Nvidia returned over 6,000%. If you had taken $20,000 at 30 years old and you put it into a concentrated technology exposure, not because you were reckless, but because you understood that we were living through a technological revolution in real time, you would have retired on that one singular position. But someone told you to diversify. Someone told you to balance your portfolio. Someone told you that bonds are safe. Bonds. When you're 30 years old and the most transformative technological build out in human history is happening right in front of you, someone told you to buy bonds. Uh, Maybe someone should have told you to buy gold, silver, or copper. It would have worked out much better. Everyone touts them as safe assets. Yeah, of course they are. Better than bonds. Forget 5% over 30 years. That's what I'm saying. There is a word for what happens when you miss compounding in your 20s and 30s. The word is irreversible. Compounding is not forgiving. Wealth creation doesn't care about your feelings, and neither does the market. It doesn't give you a second chance. That's why time is your greatest asset. The mathematics of it are brutal and beautiful at the same time. A dollar invested at 25, growing 15% annually, becomes $66 by 65. But a dollar invested at 45 at the same rate becomes only $16. That 40-year-old has not lost $50. He actually lost the ability to ever recover. You understand that? You cannot hustle your way back from missing 40 years of compounding unless and only if you start a very successful business where actually the facts are that 90% of businesses do fail. Trading, it's totally different. 90% of people quit and give up. It's not that they fail, they switch to investing and they still become profitable in the long term. The only correction is to take more risk per dollar with what you have left, which is exactly what concentration means. Now, who's this for? Well, if you have $10 million, you should diversify actually. And if you have 5 million, yeah, diversify. Even at 1 million, there is an argument for more of a defensive posture, depending on your income, your obligations, and your age. Preservation becomes rational at the point where you have built something that a market crash would actually damage at a civilizational or familial level for your society or your household, your family. Most Americans are not at that point. According to the Federal Reserve's most recent survey of consumer finances, the median American household has less than $80,000 in total financial assets. The median. That's not the bottom, that's the median, the middle of all. It's like a 90-10 split of people who have wealth and those who don't. There are people being counseled into conservative, diversified portfolios, people who cannot afford to preserve anything yet because they have not built anything to preserve. The advice they are receiving is not wrong in principle. It's simply addressed to someone who doesn't exist there at that moment. Now, if you're under 50 and your net worth is under $1 million, you're in an accumulation phase. Just accept it. Your job is not to protect capital. Your job is to create more of it, which means concentration. That means tolerance to volatility, acceptance. It means being willing to watch a position drop 30% and not flinch. Because when you're not playing a preservation game, because you're not playing a preservation game, you're playing the growth game. And growth is not linear. And it isn't always comfortable. And it doesn't feel responsible on the days where the market is down. On those days, every instinct you have will tell you to diversify, to hedge, to rotate into something safer. And those instincts most of the time are wrong. That's all I'm saying. Your instincts are expensive. The technology sector is not a bubble, simply because it is appreciated dramatically. A bubble requires disconnection between price and fundamental value. NVIDIA is generating real revenue from real infrastructure that the entire global economy depends on at this point. Microsoft is generating real revenue from cloud computing that is now the backbone of modern enterprise. Apple generates more profit than most countries produce in GDP. These are facts. These are dominant franchises in the most economically significant sector in modern history. Treating them like tulip bulbs from the 17th century because they have appreciated it a great deal is a categorical error. If anything, the people who called it a bubble in 2016 and diversified away from it are the cautionary tale, not the warning. Don't become Michael Burry, patiently waiting and seeking the market top. There is no market top. Understand that. It's all mathematical. There is a way of thinking about money that the financial establishment does not teach. which is the difference between volatility and loss. Volatility is a temporary function, while loss is a permanent destruction of capital. These are not the same thing. A young person in a concentrated growth portfolio who experiences a 30% drawdown has not necessarily lost money. They have simply experienced volatility. And if they hold, if the business is real, if the fundamentals remain intact, that 30% swing becomes nothing but a footnote. The person who sold into that drawdown to feel safer and who diversified into bonds at the bottom to stop the pain, they are the one who converted volatility into an actual permanent loss. That diversification instinct in practice often creates the very destruction that it claims to prevent. Take risk while time is on your side, not reckless, undisciplined lottery ticket risk. Concentrated, thesis-driven, high-conviction risk in assets where the underlying fundamentals justify belief. Your time horizon is decades, not months or years. Buy the technology companies, buy the infrastructure of the modern economy, understand what you own and why, learn about it. Be willing to sit through discomfort because discomfort is not the same as being wrong. Volatility is not the same as a loss. Build your conviction and your positions. Let the compounding do its work slowly. That's why compounding is the seventh wonder of the world. Compound interest specifically. Revisit the conversation about diversification when you actually have something that truly demands protection. You're just your financial advisor's revenue source. Understand that and act consequently. You don't actually need them because there's no point in having a financial advisor when you're not financially well off. There's a reason why the rich get richer and the poor get poorer, because they know what game they're playing and you don't. So that's really the basic gist on concentration versus diversification. It's very important. You need to understand, especially right now, in terms of the AI infrastructure build out and the technological revolution, the massive gains in the market, it's nothing compared to what might happen. You need to understand that history repeats, but it actually rhymes. The things that happened in the late 17th or 18th century are just good examples. In the 19th century, actually, with the railroad boom in the late 19th century, 1873, 1879, is what I would say is very similar in terms of infrastructure build out. And during that time, the infrastructure had failed to produce anything of real value for a period of time, to the point where the people who built it lost all their fortune. The people who came after that took it up and made it into something and created all the backbone of the economy that we had known in terms of railroads, and then further on, electrification and so on. So understand your time in the market, your time in the economy is at every moment. You can't waste time. Your greatest asset is time. So trust that the choices you make and the decisions that you believe in, the theses that you learn about and study, what you hear about from other people, it's not a lie. Concentration is the way to go if you don't have $1 million or $10 million. That's as simple as I can put it. Diversification works well when you have something to protect, when you have a family that you need to provide for, when you have a life that you need to keep working, when maybe you can't work and you need to have money and have income. Social Security is not going to save you. Social Security is probably going to break down, and we have a policy that's going to recover it eventually. I have a policy for Social Security that I'm writing that I'll eventually do in a different way personally, not here, but you can't rely on government programs. You have to understand the market and the technicals, the fundamentals, and the long-term prospects of prosperity in the modern economic and American economy, and that's where we are. We're still at the beginning. We're not at the end. This is the beginning. So take your chance, make the risk, make the money, and don't give up, don't fail, don't quit. So that's really all I have to say about that in terms of concentration and diversification. It's very important. Listen to that 5 times, understand what I'm actually trying to say. It's really very simple though. So I'm sure you understand